Joe, you said that in your underwriting, when you're looking at making a loan to a borrower, you weren't taking into consideration potential increases in the rent based on rollovers, that kind of thing. But theoretically, if you had a borrower with a building that was 100% rent stabilized, based upon the way that upside potential cannot get extracted out of buildings, it's very likely that the cash flow, the NOI in that building might go down year after year after year. Are you taking that into consideration when you're underwriting a new loan today?
I think the way we're trying to handle that is by using higher debt service coverages, because we have lots of loans where we've looked at and said, when this came down, we went through, as most of the banks did, the entire portfolio, did a deep dive of where do we have issues. One of the things that we knew was out there, and we confirmed once again, is it might not be what we call AHL risk, of affordable housing legislation risk, but the taxes may have gone up 50%. The water has gone up. So what we've tried to do on new originations is test them to a higher debt service coverage, so that after the 5 years or 7 years when the loan comes due, we would be able to hopefully be north of 110, 110, et cetera. But we are using higher debt service metrics depending on the building type.
And if incomes are going down, presumably, real estate taxes should be going down. Right. When you're underwriting, do you believe that taxes actually will go down? Because even from the period 2007 to 2010, when the average property in New York City lost its 38% of its value on a price per square foot basis, taxes never went down. So do you anticipate that taxes would go down in your underwriting looking forward?
We do not. We use the current taxes, and a lot of times we add on an increase as well, because we're expecting the other direction. Someone has to pay for all of this infrastructure, et cetera, and it's really on the building owners.
Okay. Jeff, the affordable housing industry has been booming. It seems like with these new regulations, everything is going to be an affordable housing project. Is institutional capital changing their perspective and maybe wanting to get more into the affordable space? Are you seeing that at all from any of your clients?
Yeah, I think there is an interest in investing in the affordable space, and I think it goes back to there's a trend towards social impact investing, or however you want to describe it. So if you look across the board, whether it's JP Morgan or Blackstone or Nuveen or Prudential, they all have these workforce housing / affordable / social investing mandates. And they want to invest in the space for sure. And so I think it's just now they've got to figure out the new rules and the new regulations and understand where the yields are. And then I think there will be capital that comes into the space once there's been some data points on the board. 'Cause right now there really haven't been any data points on the board.
And it'll probably be a little while before that occurs. We're on the market with a couple of multifamily properties now, where we consider ourselves in price discovery mode, trying to figure out what the offers are going to look like. Several of the projects we're working on now, we're not even giving pricing guidance to the clients, just wanting to see what buyers are going to say about how they interpret the value today. And so even if those properties don't trade, which some of them are likely not to trade because of the pricing levels, it's going to be very, very telling to look at what the level of offers are, how many offers there are, and try to determine what the new reset in value is. Mitch, you have clients coming to you every day. What's the most frequently asked questions that you've gotten over the past couple of weeks?
A lot of it has to do with what I spoke about. Like I have a lot of people that were in the middle of expensive renovations of their units, and they didn't rent out the units before the rent laws changed. And they say, well, what do I do with my apartment? How do I recoup that money? I know that there's an industry memo that's going around that says that if you completed your renovations prior to the new base date, that you can do the 140th, or you may be able to do the 140th and 160th. Unfortunately, I have to tell you that we asked that question of the DHCR, and they had indicated to us that they will be applying the new rules if you did not rent out prior to the base date. So what do I do with my unit? It's what I've indicated. Again, I've never seen a vacant rent regulated apartment, and the Rent Act has not changed that at all, that cannot be developed, and as part and parcel of an augmented rent roll. Even leaving that apartment vacant for a period of time, you might be able to cobble together enough vacancies, or the building might be in such a condition as to lend it to substantial rehabilitation treatment, which is going to remain untouched. On demolition strategy, which I've done at least 50 of them, over the course of the years. You may want to keep that apartment on the side to do that. And even if you have a landlocked unit that you say it's impossible, I've got a $500 studio and I can't do anything with it, maybe you can turn that studio, into an accessory use for that building and create an ancillary service, which you can make a ton of money on, by setting the rent for that ancillary service to begin with. It's a chess game. You got to move the pieces around in your multifamily. If you don't have vacancies, you move them around. And so I get a lot of that. The other thing that I get, is this part of the law, which was pretty ill-conceived, having to do with security deposits or advances. There are a lot of you guys out there, that have fair market apartments where you've taken a year in advance, or foreign students and what have you. And the new laws with respect to that seem to penalize you for doing that, limiting it even for deregulated apartments to one. And the law doesn't take into consideration, well, what if you had the monies to begin with and you're rolling over? It's a very poorly written law. But at the end of the day, if you're found to have violated it, you have to pay that tenant twice the amount of the advance, which could be a hefty number. This law doesn't work well for tenants either, because a lot of them would rather just pay the money up front than have to go buy an expensive insurance policy to basically get that apartment. I spoke with Brent Meltzer, who's head of the Real Estate Financing Bureau, about this. And I indicated to him, since you guys are ultimately going to be the ones that are going to enforce this, what are you going to do? He said that they were considering it and that they would be maybe making some policy statements on their website shortly. But until then, you can try to be as elaborate as possible to try to get around the law, but the penalty is so stiff. I would suggest, for the time being, either send them to insurance or the equivalent, or refund the monies that you have in excess of the 1 month.
Okay. Jay, Mitch touched on something interesting, that this reform has actually started to encroach on the operating mechanisms of free market apartments. A limitation on the amount of security that you can take, a notification, early notification to the tenant if you're not going to renew the lease or if you're going to increase the rent by more than 5%. Is there any anticipation that these reforms may be broadened over time to try to capture some of the free market units that are out there today?
Oh, absolutely. I mean, this is the beginning and not the end. They're absolutely going to keep coming. There's already there's been a redraft of the so-called good cause eviction bill has already been resubmitted. The state senate will be taken back up in the next legislative session. The end goal of the group that's really driving housing policy in the state government right now is a regulation of every single unit of apartment housing in New York. That's the end goal, and they're going to keep working at it until they get there.
Well, that would lead me to think, as a broker, if any of you have free market apartment buildings, there may be a bump in value today because the capital that was directed towards stabilized housing now may be focused on free market housing. There may be a pop in value that will be short-lived if those policies that Jay just referenced get any. We'll start thinking about questions, folks. We're going to open it up for questions in a little bit. Just wanted, Jay, if you could comment a little bit more on the lawsuit that CHIP and RSA have filed, what some of the aspects of that are, and if there are any previous cases or decisions that are having you feel very optimistic about the chances of the lawsuit.
Well, I mean, it's important to point out, as far as optimism goes, that we've been working on this lawsuit, this complaint, for close to 2.5 years now, in anticipation of this moment today. And we were hoping to negotiate in good faith and lobbying with the Senate and Assembly and the governor on the rent law package, but with the actual expectation that we were probably going to still have to launch a lawsuit because the current RSL, as it stands, we believe, because it, one, has never been actually challenged comprehensively in a court of law, whether or not that it does exactly what it claims to do, which is part of the complaint, and that it was time to have that conversation. We basically, the end goal of here is to put the rent stabilization system in court, and to have hopefully a third-party moderator, in this case the U.S. Supreme Court, decide whether or not it is a system that actually achieves the goals in which it lays out, whether it fairly supplements the income and the resources of a building owner who has the property, whether or not the government is forcing the owners to do such supplementation of another person's hardship. So those are the basis of the argument. It's 3 claims that it violates the substantive due process rights. I'm not a lawyer, by the way, so let me make sure I'm reading off my paper. I'm a real estate lobbyist, which is bad enough, so I can't be a lawyer too. Too early for jokes this morning, I guess. So it violates the plaintiff's substantive due process rights because the law is not rationally related to any problems that it's trying to solve, and because there's no rational basis for declaring a housing emergency every 3 years. So every 3 years, the city opts into the rent stabilization law. We do this dog and pony show with the Rent Guidelines Board where they come out, and we actually use the Rent Guidelines Board's own data in the complaint. They consistently say that the cost of operating increases continue to go up, and yet, as we know, the rates for increases that are voted on every year are substantially lower than those increases. So we believe that highlights part of the taking argument. We've also done research compiled from the Department of Finance's own data that shows historically RSL units, buildings that are in the rent stabilization model, as opposed to free market units, are on average 20 to 30% lower in value historically than those units that are not, that are free market. So we believe that also highlights the taking argument. The second part is that the owner is required to continue leasing to individuals not of the owner's choosing, that particularly in light of the latest amendments, the 2019 amendments, the owner's ability to use their property for any purpose other than renting the property at a stabilized rate, conversion to condominiums, the eventual deregulation of a unit at high income or high rate have been effectively eliminated. Those amendments remove the last few sticks and bundle of rights of a property owner's ability to regulate their own unit. We also believe that it's a regulatory taking. There have been other prior court arguments that basically say that the RSL is a public subsidy, and yet one of the few public subsidies that's provided for by private owners and not the government, and that there isn't an actual system to compensate owners for this subsidy, despite what the rhetoric on the other side is about tax credits, et cetera. There is not an actual linear system to compensate owners for this subsidy that they provide. And again, the goal here is to obviously defend property owner rights, but ultimately to figure out a better system to provide affordable housing for New York City. We are a city that is choking from the lack of units across the spectrum, but primarily in the affordability sector. And these are the very tenets in which the legislature claims that they are renewing this emergency, which they have further made these draconian laws. So we believe that it's time to have an honest legal discussion about whether this system actually works.
Right. Great summary. Jeff, I want to talk about foreign capital for a second, then we're going to open it up for questions. Foreign capital in the multifamily space has historically come in mostly in the form of equity financing as opposed to direct purchasing, but can you talk a little bit about foreign capital, what you're seeing, and how these laws might impact the appetite that foreign capital has for multifamily property here?
Sure, yeah. I mean, when we think about foreign capital, we also break it into sort of institutional foreign capital and private foreign capital. So I think the institutional foreign capital, similar to the domestic institutional capital, they're trying to digest what's going on and they're going to be somewhat cautious. I do think what we're seeing on the foreign capital that's private family office capital that's coming from all over the world, we're still seeing that capital come in, and we're actually seeing them have a lot of interest in some of our deals in New York. So for example, one deal, we've got a Mexican high net worth family that's taking a hard run at it. We have another deal that actually Chinese high net worth investor is looking at. So I think the foreign capital will be dominated by more so high net worth and family office capital for the time being. And it'll take some time for the more institutional foreign capital to come back in.
Got it. Okay, Mitch, you want to comment on your perspective on the lawsuit?
Yeah, I took the time to read the 121-page complaint, and I want to commend RSA and CHIPS and Meyer Brown and the individual plaintiffs on a very scholarly piece of writing. There are many issues there that are thought-provoking. I would say, it's funny because I was speaking to a client of mine, Matt Miller. Are you out there at all, Matt? You out there? Yeah, I was speaking to Matt. He's an investigative journalist, and I was saying to him generally the other day, it's really maddening because every time there's a constitutional challenge to the law, the city or the state propounds certain excuses and, as to why the law is still constitutional. And then 5 years later, they changed the game. And I was wondering what the nature of the opposition was, the maintaining the Constitution, to the argument that the laws were constitutional, the last serious challenge in 2010, the Harmon case. And Matt didn't think about it for a second. He sent me the SCOTUS brief that was prepared by Schneiderman's office when he was the AG. And it's very instructive because they told the Supreme Court that the rent laws were constitutional, and I'm quoting here. They told them it was constitutional, because landlords were still being insured to earn a reasonable rate of return, that they have a vacancy bonus, that they can get, gone now. They say here that an owner can withdraw one or more apartments for their own use in here, gone now. They state here that there's high income and high rent deregulation, gone now. They state here the RSA envisions a gradual and orderly transition to a housing market where regulation of rent increases is no longer needed. Absolutely false. They state later on in their brief, the RSA, while the Harmons would no doubt prefer a policy of immediate deregulation, the legislature and city council have rationally chosen to pursue a gradual transition to an unregulated market by deregulated units when rents increase beyond designated thresholds. This is the stuff that they were feeding our courts to defend the last constitutional challenge. And quite frankly, today, and I'm going to try, if I can get an audience with Maya Brown, I'll speak to them further, it should be thrown back in their face. It's a complete estoppel argument.
Sounds to me, Jay, like Eric Schneiderman should be one of your co-plaintiffs.
Is he out in public now?
One last thing as a practical note, some of you out there are getting myriads of literature from the DHCR because no sooner was the ink dry on the new Rent Act that they started demanding documents going back 6 years on all pending cases. You should put in every one of those cases, whether you're litigating in the courts, or in front of the DHCR, a motion or a request for a stay pending the result of the Fed court resolution.